Today we're talking about wrap accounts, and that is WARP, not the monster RAP. Is that right, Vince?
It says WRAP.
Yes, WRAP, wrap
Which is
accounts.
not a radio station in Denver.
No, is it? You're listening to Nightly Talk with Glen and Vince, WARP Denver. But look, it comes up a lot in the Retire Right Facebook group. It comes up on online chatter. You may be a client of a financial advisor and you have a wrap account. You may see a financial advisor and they recommend a wrap account. We're going to kind of spend half hour or so together and just unpack what a wrap account is, advantages, disadvantages. I put up in the Retire Right Facebook group a call out for questions, and people have got some questions. We'll look at them. So we're going to get into it. Vince, you got something to say?
I'm Vince Scully, founder of Life Sherpa, and you're on Retire Right.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
Okay, Vince, wrap accounts. You know, if I zoom out 30,000 feet, what I see primarily in the Facebook group, there's this underlying tone that, well, there's a few underlying tones that...
The undertones.
The undertones of financial advisors only want to put people in wrap accounts and get their mitts all over your money. That's like number one. Number two, wrap accounts, they're more expensive in terms of super. Mm-hmm. The other one that I see is wrap accounts, I have to have them through a financial advisor. Do you see any other kind of negative? Because it's more negativity or it's people. It's just, and this is why we're doing it today. We just want to educate people.
It's lack of knowledge, and a lot of it. You see this sort of conclusion happening, or when people jump to product and tactics before strategy.
Right.
That it's a product that's got some significant advantages, which means it will be a better super solution for many people, not all, but many. And it does come usually at a slightly high cost, depending on what you're comparing it to. But those advantages for people with far enough from retirement and big enough a balance will generally be outweighed by the benefits. But you've got to start with strategy, your 30,000 foot
view. I probably should disclose at the time of this episode being recorded and going to air in the next few weeks, you know, it's the end of May, and this podcast, we are running ads and we have received money from Aware Super because that...
I'm aware of that.
Yep. Thanks. Good. Wow. And on the Money, Money, Money podcast, we've been doing some work with ART, Australian Retirement Trust. So, yeah, I've been paid by those two companies at the moment and recently, so those names might come up.
Cool. Have you got your big fluffy super monster?
I do. He's in the corner somewhere. But I think all that to say, and I've said this to any brands that work with us, not every product or brand is for everyone.
Correct.
And that's where we can get into trouble in the Facebook group and online, because people might have a super fund here and they're telling everyone, oh, you just got to go to this super fund because I use this. It's like, well, no, not every product and every service is for everyone. So we are talking primarily about super wrap accounts. The wrap word, that's not an acronym, is it?
No, it technically these things are called IDPSs, Investor Directed Portfolio Services, which is probably a better description of what they actually do. But the word wrap has become a colloquial term or slang term for IDPS. Some of the product providers have included in their names.
Like
Macquarie Wrap, for example.
The old BT
Super Wrap,
Yep.
which incidentally was the first. But I think the investor-directed portfolio service is actually the better description because what it is an opportunity for you to direct the trustee of the super fund to invest the way you want.
Is that always a good thing, though?
Well, it is if you're doing that with the sufficient knowledge.
Right. So
But obviously control without capability is useless.
Yeah, so the word wrap was basically you could wrap all your assets in the one account.
Yeah.
And wrap accounts generally have a cash account, and it might be a Macquarie CMA, or it might be insert cash account here. It will have it at a BSB and an account number.
Yeah.
You put money into that. You log into the IDPS or the wrap account, and you can place trades and buy listed stocks.
Yep.
You can buy ETFs, managed funds, potentially some other stuff.
Direct shares.
Listed stocks, direct shares. So
Annuities.
term
Deposits.
all the things, all wrapped in the one account. And at the end of the year, you get the consolidated report. There are features if you had 5 ETFs and you wanted each of them at 20% weighting. Some providers, depending on what they are and how they're set up, you can set your own target or model portfolio and rebalance it automatically. So complete customizability, functionality, all the cool stuff. So that's effectively what a wrap account is.
It is. And it's really an unbundling of the things that go to make up a super fund.
Okay, talk to me about that.
So when I look at a super fund, well, when you consider a super fund, you're buying 3 broad categories of services. You're buying compliance and custody, which is really the entity that issues the PDS, designs the structure, keeps the accounts, holds the license. And, there's 165 of those providers in the country, and they all have a thing called a RSE, a registrable superannuation entity. And so you have to buy it from one of those. The next thing you're buying is portfolio construction, and that is so if you buy a balanced fund, somebody has decided that a balanced fund is 70% growth, 30% defensive, and it's going to be invested this amount in Australian shares, this amount in international shares. That's portfolio construction.
Yep.
And then you've got the third bit, which is the actual funds management. And most of the big super funds outsource most of that.
But some of the big super funds, I mentioned 2 before, ART, Aware Super, we've got Rest, we've got Hester, we've got Australian Super, Cbus. Am I missing any of the biggies? That's probably Unisuper, they're biggie. They will have
Hester,
yeah. They will have, we'll go there. So their international equities, they'll generally invest via a company in London and outsource that, but they might own the shopping centre down the road.
They might do. So they range from 0% self-managed. So Host Plus, for example, manages no money in-house.
Really?
That's right, not a cent. At the other end of the extreme, you've got Aussie Super and Unisuper, which are sitting up around the 50 to 70% range. But most funds are in the 10 to 30% range. That's not either a good or a bad thing. In fact, many ways, more outsource is better because you're now able to buy the best of breed. And
you're paying for some IP potentially with portfolio
and
construction.
And of course, if you do it in-house, you've got to employ these people, which means if the mandate doesn't deliver what you thought it was, not only do you have to just sack the manager, but you now have to get rid of a whole team and overhead. So outsourcing is a good thing. So they're the 3 services.
And can I just maybe do a visual for people listening and watching?
You're a visual kind of guy.
I am on YouTube. I want you to imagine the super world as a round circle with another circle a little bit smaller and then another circle, even like a bullseye, if you will.
Yep.
I'll see if I can just...
Like concentric circles.
Yeah, well, just like if you're watching on YouTube, you can kind of see that. So the very outside circle is the trustee, the RSE
yeah.
RSE that you talked about.
So that defines structure. It defines who's responsible for delivering it.
Yep.
It defines how they're regulated, and usually that's the brand.
Yes.
So all of those names you just mentioned all are RSEs.
Yeah. So within each, so then we've got the next circle within that is the investment option,
Yeah,
which
so
could be your high growth
That's
or
your
balanced growth.
portfolio construction.
Yes.
So somebody, usually someone in-house with the help of outside asset consultants, will go, here's what our 70-30 portfolio is going to look like. Here's how we split it between real estate.
And you could say, Vince, that second circle being the portfolio construction is their IP, because they feel that they want for this portfolio 30% to Australia.
Yeah. And that decision, so the asset allocation decision drives 90% of your risk and return outcomes. So that's critical.
Now, the next bullseye, or the next little part of the puzzle, is the second one have said, yeah, we want 30% to international equities or whatever it is. Then they take that next round circle and be like, okay, so are we managing that ourselves or are we outsourcing the investment?
And for the vast bulk of funds, that will be an outsourced decision.
Yeah.
And they will then run a tender and say, I want someone to deliver a global large cap value fund or mandate.
Insert whatever here.
Insert style here. And they will then hand that money over to an external manager to manage.
And I think that's, and we haven't really talked about wrap accounts yet because we just need some foundational understanding of how super funds work in the lay of the land. Look, there's probably if I draw a line and then another circle off the edge, Vince, it's probably, and I'll just put that up on for the YouTube.
Is that a carbuncle on the edge of the circle?
Yeah, so that's probably when you bolt on insurance.
Yeah.
So anyway, but that's for completeness.
Yeah. But those three fundamental pieces, so the RSE decision, to our mind, is largely a size and structure question.
Yep.
So of those 165, we at Life Shepherd limit our coverage to those who manage $10 billion or more.
Yep.
Which instantly means Vanguard's not on that list. They will be soon, I suspect, but today they're not. And that's because running a super fund is a scale game, right?
Yep.
It doesn't cost all that much more to run a fund with 1 million members than 500,000 members.
Yeah.
It's also a negative, so you have to be, because the bigger they are, the less they're able to make small decisions. So if you're managing, if you're one of the big 8 that manages more than $100 billion, you can't make $1 million decision. So you can't invest in a small company outside the ASX 300.
Because it's too much.
Because you have to make too many of those decisions.
Yeah.
So in asset consulting, they call that relationship budgets. So how many decisions can you make? How many managers can you deal with and still run a $150 billion fund?
So back to the cricket.
Yeah, but sorry, just on that. So structure.
Yep.
So that decision as to which RSE I buy this from dictates that sort of size and scale and scope. And it also, importantly, when we come to actually talk about wrap accounts, it defines structure. And structures are either pooled, like most of the big public funds that you'd be familiar with, where everyone's money is tipped into.
So the big public funds, we're talking about the big industry funds and big retail funds.
Well, effectively,
any fund that you can buy on their website.
Everything that's not a self-managed super fund or an IDPS will pool the money.
Yep.
And that's got some tax implications, which we'll come back to when we talk about wraps themselves.
Yep.
But those two decisions are the next biggest decision after asset allocation.
Cool.
And that's fundamentally driven by which RSE and which product you buy.
Yep. So, and this could be a yes or no answer, and just to dispel a myth, does every financial advisor, if any of our listeners go to a financial advisor, does every financial advisor just want to put people in a wrap account?
No. I mean, all financial advisors are what are called fiduciaries, so they owe a duty of care to their customer or client to act in their best interests. And that means recommending the strategy, tactic, product that best delivers that outcome. Clearly, 10 or 20 years ago, there were obviously commercial incentives to do some things. So a lot of this noise on the internet dates back a decade or more. But no, a financial advisor has no particular incentive to recommend one over the other.
Well, I've talked freely on this podcast. Martin McGrath, who hosts episodes, Martin well.
Yep.
My parents went to Martin. He literally left them in the same funds that they had because the shoe fit and everything was working. He didn't go, all right, we're moving Wendy and Des to a wrap account tomorrow.
No, but to be fair, if we talk about best solution for the application, I would say that when you look at the numbers and the evidence, if you're more than 5 years away from retirement and your balance is more than $50,000, you will almost certainly benefit from features in a wrap account that are not available in a pool fund. We'll come back to that, but that's an important point.
But I will just scratch that little thing on the table there that you're talking about. The features and benefits will be more apparent than a potential off-the-shelf fund, even if it costs a little bit more. And my next question, do all wrap accounts cost more than the public offer funds that are your industry funds, your big retail funds? Can you make that?
I don't think you can draw that conclusion generally, but some of the features cost more to run.
Yeah.
So it costs more to run 600,000 segregated accounts than it does to run one single 600,000 pool. That cost will usually be repaid through the tax savings, if nothing else.
Yeah, and that's kind of what I'm getting at. It's like if the features and benefits and the tax savings using a wrap account is fundamentally more advantageous to you as a
then you should
consumer,
do it.
But if the fee costs more...
Well, I mean, obviously part of the skill of an advisor is...
Because I think you're going there, but I'll just kind of finish my train.
Sorry.
A lot of these questions in the Facebook when people are like, advisors recommended a wrap account, I'm scared. The advisor hasn't clearly articulated the benefits and the rationale.
Correct.
So, and then my final point, and I'll throw back to you. This money thing, it's a psychological game.
Yes.
Because it's the only thing that when you last bought your car and you buy one car every 28 years or whatever, you don't go to the car dealership and say, what's the cheapest car? You don't Google cheapest car for me, Australia.
Some people might.
Some people might. But you go, what do I need? What's going to be most appropriate for me over the next 10 years on balance? Okay, I need this car. Okay, this is the cost. This is the benefit. Oh, no, but you can get a cheaper car over there. Yeah, I don't need a $17,000 brand new MG. I need a Hilux.
Yep.
So, and that's the psychology, isn't it?
It is. And, fees matter, don't get me wrong. They are, after asset allocation and tax, probably number 3 on that list. But they only matter when you're getting what you need. So a box of 4 eggs might be cheaper than a box of 6, but if you need 6 for the recipe, it's not cheaper.
That's right.
And it might not even be cheaper per egg.
Yeah.
But it has got a lower price. But clearly the cost of delivering a pooled fund can be lower. And some of the biggest funds, the big 8, which manage 100 billion or more, some of the entry costs are actually very low. But the average cost of a $50,000 balance across all funds is just over 1%.
Yeah.
When you add up all the costs, including that innocuous seeming $78 a year or $1.50 a week, on a $10,000 balance, that's 0.75%. So fees matter, but you've got to look at whether you're getting what you need first, and you've got to look at the net outcome. The net outcome is a function of No, structure, asset allocation, your behaviour, taxes and fees.
Yep. Well,
Probably in that order.
we'll be back right after this, and we're going to, now that we've set the scene, detail the benefits and the uses of a wrap account. We'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Okay. I'm just having a look these questions here.
So can we just tie that split, the unbundling concept, to what it looks like when you buy a wrap before we move into the
Yeah.
So we talked about those three services. So when you move to an IDPS, what you're doing is unbundling those three services.
Right.
So
So the bullseye or the three circles, you're basically splitting them apart.
So you're going to buy the outside piece, the structure, the compliance, the custody from the wrap provider. And they're all RSEs as well. Some of them are bigger and older than many of the big names you will be familiar with. They don't all have big consumer advertising budgets, so some of these brands may be more or less familiar. The next piece, the portfolio construction piece, you're going to buy that from your advisor, and your advisor may or may not outsource that. So some advisors do that in-house. So at Life Sherpa, we do that exercise in-house.
Which is your IP?
Which is our IP. I mean, that's where we deliver the returns that we do. And they're the same portfolios that's available on Life Sherpa Invest. And some advisors will buy models from
Lonsec
research
or Morningstar.
Or they might buy what's called a separately managed account, or
like a portfolio in a box.
Which is a portfolio
thing.
in a box. So Beta Shares or Russell all sell those sort of things. So understanding that's important, and understanding why you're dealing with that particular advisor, because all advisors have their own specializations. Where we're evidence-based, so we look at asset allocation as the primary driver, and then we focus on structure and cost beyond that. And then you're going to buy the funds management piece from a fund manager. So in our case, we use the three big brand names that you would recognise: Vanguard, BlackRock, State Street, and a whole bunch of others. Some of those manage trillions of dollars. They are individually bigger than the entire Australian super system. And by combining those three building blocks into a tailored solution for your needs, you're going to get greater control. You're going to get better tax outcome.
Just for the YouTube, I'm just showing them the three circles
again
that are now they're now split.
Okay.
So we've gone from all in the one place with a wrap account. We'll split the trustee there, the portfolio there, and the investment.
Yeah, and so by having your underlying funds bought from best of breed. So, Vanguard's Australian Share Fund, you probably hold some in your personal name, your VAS or your IRZ from BlackRock.
Which is effectively just the index anyway.
Yeah. So they're, that's the cheapest way you can get access to an Australian share fund. And so an ASX 300 fund bought from Vanguard is probably not materially different to the Host Plus Australian Index Fund.
Yep.
And they're similarly priced at that sort of single-digit basis point price. And so that control, so it gives you control and better tax. And perhaps that tax point is the bit that gets lost in a lot of this, because this could be worth 0.3%, 0.4% a year to you, which when you look at the fee argument is pretty material. It's a bit arcane, but it's probably worth spending 30 seconds working through why
we might do that, but we might quickly
Perfect.
answer some questions. Yeah, Dave said, do some platforms tie you to a financial advisor?
Well, I mean, if you go back to the unbundling,
Yeah.
well, if you're buying portfolio management from your advisor rather than from House Plus, well, yes, if you don't have your advisor, you don't get that portfolio management.
Yeah.
But you can move to a different advisor. You may be able to take the whole wrap and deliver that service yourself.
It depends on the provider.
Yeah, and your,
So I think,
and your
like,
ability. So
Does Hub24 or Net Wealth allow you to do it yourself?
Some of them do. Some of them will allow you to set the account up on your own. Some of them will allow you to keep it if it was set up by an advisor. But the real reason they don't is not some sort of monopolistic or attempt to stifle competition. It's
gatekeeping and all
about,
that.
do they have the call centre capability to service 600,000 people?
Yeah.
And the answer in most cases is no, they don't. They're not set up to manage hundreds of thousands of individual accounts. They look to advisors to deliver that service. And so that's something you need to decide. But this point of, does it tie me to an advisor? Well, it ties you to an advisor in the same sense that it ties you to House Plus. So if you buy the 3 services from House Plus, then if you don't like any one of those 3 services, or their call centre more likely, you're going to move.
Yeah.
So if you decide, I don't want portfolio management services from Life Sherpa anymore, then, well, you need to go and get a different portfolio. I'm presuming the reason you don't like it is that the portfolio is not meeting your needs, or you don't think it is. Therefore, well, how do I do it? Well, I go and choose a different provider. Do I choose a different unbundled provider, or do I choose a different pool provider? That's the same decision as moving from Aware to House Plus or vice versa.
Dave actually also said, and can you move out without incurring CGT? That's probably more of an in-specie question.
Yeah.
And I'll go to Andre's question. How does an in-specie transfer work differently with a wrap account compared to a straightforward super account? That will probably tie into the tax thing.
We've got to get to the tax point to answer the question.
We will get to that because we will take some time on that.
But to deal with the first part of who's with that first
Dave.
question? The first part of Dave's question is that when you move super funds, you are in effect paying capital gains tax. You don't see the bill, but it's built into the unit price. When you move your wrap from one advisor to another, so you want to swap out the portfolio management piece of that exercise, that is usually just a book entry and there's no tax implications of that. So in many ways it gives you more control and more flexibility rather than less. But the overall CGT and in-specie common is one of the key differentiators, and takes a little bit of a while to get your head around, but it is a material difference. And it could be, 0.3% a year or 5 to 10% of your retirement balance. This is a big deal, guys.
Okay, so I've just quickly Googled, I just did Australian super high growth option. What is the transaction cost, or what we call the buy-sell spread? And that is for the high growth investment option, 0.05%.
That's the transaction cost.
Yes.
Yeah. I don't think they have a buy-sell spread.
Well, but it's effectively the same thing.
Well, the distinction, they're covering the same expenses.
Yes.
One's an ongoing cost.
Yes.
Which deals with the brokerage and
okay. So,
the other one is when you come and grab. They're covering exactly the same expenses.
Yeah.
Most of the big funds, do I say most? Certainly many don't have a buy-sell spread.
Okay.
But when you go and buy VAS from your broker,
there's a spread.
It doesn't have a buy-sell spread, but there is a difference between the bid and offer price on the market,
which is effectively
the same thing.
Yeah.
But it's just being fair to everyone else in the fund, because by moving in and out, you are imposing costs on the fund.
Yeah.
And why should they be spread over the 599,000 people who are staying behind? You should wear that. So in many ways, not having a buy-sell spread is actually a bad thing.
Yeah. Yeah. So I just did ART. Their transaction cost on their high growth option is 0.06.
Yeah. You should expect a number somewhere just less than 0.1.
And for everyone freaking out going, ART's more expensive on their transaction cost, they're 0.06 and versus 0.05, that's what we call the same.
Yes. That's called vanishingly close to zero.
Yes. So all funds will have these costs. Talk about the unitized fund and how the pool structure works. So if I put $200,000 into a fund, ART for example, in the background, if the unit price is $1, I get 200,000 units. Is that how it works?
That's broadly how it works. But and this is a relatively recent phenomenon. When super funds started, they used what's called a crediting rate, which they credit a percentage of your account based on the return. Through the 90s and 2000s, most of the funds moved to a unitized offering, which is sort of easier to understand. And you sort of have to do it if you're offering daily liquidity, which we do today. But the way you get to the unit price is effectively saying, here's the total amount of assets in the pool. We're going to divide that up into millions or tens of millions of units. And so we can put a value on what a unit is. And that's the price that when your employer puts your quarterly SGC in, that's the price you buy the underlying assets at. And when you move from one fund to the other or start a pension, you get that price. And that is where this big difference
Okay,
comes
practical example. If I had, we'll keep it round numbers, $200,000 and the unit price was $1.
Yep.
So effectively, when I say to the super fund, I want to move my 200,000 units, effectively, because I don't care about the price for this example. Kind of is. If I want to move my 200,000 units or my $200,000 from accumulation to pension phase, in the background, the big pooled funds literally have to sell your 200,000 units and repurchase $200,000 worth of units in the pension product.
Correct.
Which could mean that you might end up with 180,000 units.
So the unit prices in the two don't necessarily bear a direct relationship.
Maybe. If we were changing investment options, it was a bad example.
But you're right. And that means that and this is because you're moving to a different pool. You're moving from a pool that's taxed at 15% to a pool that's taxed at zero. So you've got to remove all of that tax accruals, which we'll come back to in a moment, in the accumulation phase. So what you're going to do, you're going to redeem your units, which means that you're going to get the redemption price, and that redemption price includes an accrual for the capital gains tax, which is important, which we'll come back to.
But on this, because we've got to redeem these units, in theory, if you have 200,000 units at $1 each,
you get $200,000.
Yep. But the redemption, round numbers, you may only end up with 195,000 units or dollars rather, because
of the buy-sell price
of the cost difference. Yep.
That's absolutely right.
Now, just as a teaching point, that's in one of the big funds. If it was in a wrap account and I had $200,000 invested in a portfolio in accumulation, what if tomorrow I turn 65 or 60 and stop working and want to start a pension?
That's just a ticker box.
It's okay. So we don't have to sell down the 200,000 and repurchase.
And that's where this benefit comes from. And to understand how big a material this is, you've got to go back to look at how investments are taxed. So, most people listening to this will own some ETFs or some shares. And when you invest in Australia, you pay tax in the current year on your dividends. So when you buy a CBA share, you're going to get a dividend every year. That dividend might come with some franking, and you pay tax on that in the current year. When the value of that CBA share goes up, and obviously it has gone up quite a lot recently, you only pay tax on that gain when you sell the share, right?
Yes.
And that's where this anomaly arises. So now if you think about that CBA share being in a pool with 600,000 other people, with some CBA shares that were bought yesterday and some that were bought 20 years ago, and maybe even in some funds pre-CGT, that when we're creating the unit price, we have to take into account the fact that although each one of those CBA shares has the same market value, because that's what you trade them on the ASX.
Yeah, it's the same CBA share.
Yeah. But they all have different tax outcomes. So when the fund sells that 10-year-old one, which they bought for $10, for $100 today, the members are going to wear the capital gains tax on the difference between the two. So not every CBA share is worth the same. So the way they fix that problem to make it fair is the unit price we just talked about includes an accrual for that tax. So that makes so when your employer puts some money in, you're not buying someone else's CGT problem from 20 years ago. You're buying those assets at their net realisable value today. And similarly, when someone moves out, they don't get to move out and leave their capital gains tax liability behind them.
You've got to take it with you.
So you've got to take it with you. And that's why the unit price is fair to everyone. So far, so good. So whilst everyone's in accumulation, that's not a problem.
It's more if I want to take my money from accumulation to pension.
So since 2007, when pensions got zero tax, this suddenly became a problem because now if you held those units or those shares, you'd never pay tax on this unrealised gain at your 60th birthday. But because you have to redeem and resubscribe, you are now crystallising that gain. And if you're in a growth or high growth fund where 40 to 50% of your return is coming through capital gains, that means that that tax impost is somewhere between 5 and 10% of your retirement balance, depending on, if you've been in index funds, it'll be bigger, which is part of the advantage of being in an index fund. So that means that at the point of retirement, the same investor, so we compare the pair here, the same investor in a segregated account will pay zero tax and take their whole $100,000 with them. The net impact of taking the same set of assets in a pool fund with redemption and resubscription means you'll end up with 5 to 10% less dollars. And that's where the key advantage comes from.
So if you had $300,000 in your accumulation account and moved it to a pension account with insert unitised pooled fund here, moving it from accumulation to pension, if you did that same move, if the money had been on a wrap account or IDPS, you could potentially save $15,000 to $30,000 in tax.
Correct.
But you're just not seeing
You'll
that.
never see that because it's
hidden
in the unit price.
It's buried in the unit price.
I mean, nobody's doing anything nefarious. It's just how
And there's nothing illegal. None of these big funds are doing it. It's just literally the structure and how these mechanics literally work.
Yeah. Now, in order to get that, it costs more money to administer 600,000 separate accounts than one $600,000. So you'll find that the admin fee is a little bit higher, which is why bigger balances work better.
Yeah.
So if you're a 23-year-old hospital worker with $5,000 in Host Plus, this is not something you should be worried about. But if you've got 50,000 or more, and you've got 5 years or more to go to retirement, this is a big deal that you should be caring about.
When I was a retail client of yours, before I did the dirty and went to self-managed super fund, the platform that you had me in was a wrap account, effectively.
Yep.
The total fees that I was paying was actually
just over 1%.
Yeah, but if you look at some of these other funds, it's not that different.
No, it's not. So
there is this myth out there, and it's funny. When I was looking at this, get this, back to the, I just did Host Plus, they don't have a transaction cost, but their investing fee bundle is just under 0.8%.
Yeah. So if you've got a 50,000
versus that 0.78 for their high growth versus we go back up to the Australian super one at 0.51.
Yeah.
And ART at 0.66. Like, all I'm saying is it's just a myth that wrap accounts are hugely expensive.
There's nothing intrinsic to a wrap account that makes it necessarily hugely more expensive. It is, the admin cost is higher. There's no two ways about that. So particularly for compared to some of the bigger funds who've now abolished their asset-based admin fee.
Yeah.
So our friends at Host Plus, I think the fixed admin fee is like $78 plus $32 from reserves. Now, on a $1 million balance, that's
Whatever.
neither here nor there.
Yeah.
On a $50,000 balance, though, that's 0.5%. So you've got to look at and whereas a typical wrap platform is probably more like 0.3, 0.4 maybe, depending on.
Yeah, because you basically in terms of the wrap fees, there is potentially 3 sets of fees. The first set, I used to draw it.
It's exactly your same circle.
Yeah, well, that's it. Like, I actually drew it the other way. I drew it as a line, and that's the wrap account, and you pay the wrap provider a fee to walk in the door to have your money on their service.
Yep.
Then you might do some line graph bars or some bar graph, your different investment options. Each of those investment options will have their own internal fee.
Yep.
Then it's the fee for the advice. Now, this is only an issue if you've got a $200,000 super balance and you go to an advisor and like, you got to use a wrap account. We charge $8,000 a year ongoing as our fee. That's a showstopper right there, because there's just not going to be enough scale to make it work.
Yeah.
But if you rock up with $1 million, it starts to look very reasonable.
Yeah.
If not, and if you look at the Vanguard Advisor Alpha research, fascinating.
Like 3%.
Just having an advisor in your corner, they've worked it out, the data. Don't take it from us. Google Vanguard Advisor Alpha. Clients with an engaged advisor over the long term earn 3% more.
Yeah. And, when you hear that, you go, well, Vanguard, they'd have an incentive to slant that research. But in many ways, Vanguard has a very high direct-to-consumer business. So if any fund manager has an interest in playing down that number, it would be Vanguard. But, you look at the numbers, Russell do similar sort of numbers.
Yeah.
They come to a very similar conclusion. The Australian Institute of Actuaries comes to a very similar conclusion. So when you look at all of those groups putting out research, and you've got to accept that most people have an axe to grind when they put out research, that no matter which side of that argument you run, the answer does come out to be a similar sort of number. But when we do the comparisons, the average $50,000 balance in a public offer fund is somewhere between 1 and 1.2%.
Yeah.
I'm talking fully diversified funds. And like my super products, whereas our growth portfolio in an IDPS is probably running at about 1.2 to 1.3, including our fees. And if you're saving 0.3 in tax, well, you're ahead already before you look at any of the other benefits. And so it's about aligning the solution with the consumer's needs. There is no one right answer.
Yeah, and I guess kind of back to this whole wrap thing, I guess what I'm trying to say is, what if somebody was listening to this and they were 60 years old and had $600,000 in ART, Aware Super, Host Plus, Australian Super, all the it's not a bigger deal because the accumulation has been done. Because if they move to a a wrap account, you can't in specie, and we need to swing back around to in specie, you've got to do a full redemption anyway.
So I'm not following that.
Yeah, so like if I had $600,000
Yep.
and I was 60,
Yep.
about to retire,
Yep.
the tax horse is already bolted.
Well, you've obviously built up this unrealised gain in your
But
fund.
if I was 30 years old, had the working life ahead of me, that's where the value is.
It is. But when we do the analysis, anything over about 5 years is material.
Yeah.
So if you're 5 years away from retirement,
Yeah, do you want to sell now and rebuy now rather than doing it at the end?
that's right. But there are other reasons. That's the big one for younger people.
Yeah.
So if you're 20-something, 30-something, 40-something, early 50s or mid-50s, depending. Well, if you're going to retire at 65, then up to 55 or 60 even, you're going to win on the taxes on that alone.
But it's also the advantages for wrap account. It's just not the tax thing.
No, that's the one that's easily quantifiable because I can go. I can clearly demonstrate. Look, if you've got this type of portfolio, here's the component that's capital growth. That's what's going to look like at age 60. That's a mathematical certainty. It's not about performance. It's saying like for like, you will be 0.3 to 0.4% every year better off. So if you're paying...
But Vince, it's too expensive and they just want to keep me there, the advisors.
Yeah. I mean, I just bring this back to you can only look at price when you've identified solutions that meet your needs.
But it goes back to the car thing.
Yeah. And sure, I mean, you can compare these solutions. And we do this day in, day out. And most of our new members come from one of the big 8 funds.
But we get inquiries come into the Retire Right website where people click get help. And people say they want to speak to an advisor. And there's like a handful of them like, not interested in a wrap account. Like just straight off the bat. And it's just, okay, well, ask the advisor about some of the features and the benefits. But all that to say, when I said earlier, Vince, not every product, not every solution, not every service is for everyone.
That's right.
I'm quite happy to have Aware Super sponsor the podcast because the product in itself, it's not a detriment to people.
No,
it's
a different solution.
These are all solutions. So, but part of this podcast is to educate people on the financial landscapes. There are funds that I wouldn't accept their money from to advertise on this podcast. Just wouldn't because of some reasons that, I've had with my experience. But all that to say, not everything is for everyone. So wrap account, we've talked a lot on the tax side of it. Talk about transparency with investing because we need to wrap this up.
We'll wrap it up.
Don't excuse the pun.
So we said at the beginning that asset allocation drives 90% of your risk and return outcomes. So if you, that's what the evidence shows. So if you take that as a given, getting what I think I'm getting, so getting the asset allocation that aligns with my needs is therefore a critical outcome. So if you, based on your age, risk profile, money personality, time to retirement, if that leads you to a conclusion that you should be in a 70-30 portfolio, say, as an example, then when you go shopping for a 70-30 portfolio, you want to make sure that you're actually going to get one. Now, that might sound a bit bizarre, but when you look at most of the big pooled funds in their diversified options, not talking about specific sector funds for the moment, which create a different set of analysis. But if you look at a multi-asset, multi-manager investment option offered by any of the big funds, they usually have very wide ranges of asset allocation. So it might say, here's our 70-30, but it actually could be anywhere from 60-40 to 90-10. And that's necessary when you're running a pool fund because when your employer rocks up with $1,000, they don't take that $1,000 and divvy it up among the 30 managers they use.
No, it just gets part of the net in and outflow, doesn't it?
They will go and agree a mandate with, let's say, Vanguard as an example.
Yeah.
I mean, Vanguard pulled out of that market, but they used to be there. So they would say, Vanguard, I want a global index fund and I'm going to give you $100 million. And that's the agreement. So they don't take it back and give it. So the asset allocation will drift from time to time. There's also a bit of an incentive to let it slide up in good times to help in the league tables, but you need that flexibility when you're running a pool fund. With a segregated account, you can be absolutely certain, if this is what you're looking for, that when I construct a 70-30 portfolio at Life Sherpa, we will have very tight bands. So we'll say, this is how much should be in Australian large company funds, and we will meet that by buying units in Vanguard Australian Share Fund. And every quarter we'll pull that back to where it should be. So you can be certain that you're getting what you think you're getting. And what's more, you can see every share that's inside that Australian share fund. So if you care about whether you're invested in Woodside or whatever your choice is, you can see precisely what's in your portfolio. That's more difficult in a pool fund. Sure, they have to publish this document called a PHD, a Portfolio Holdings Disclosure Document, every 6 months, I think, which is usually pretty good at disclosing the direct holdings. So if you want to look at what shares they hold on public markets, they're itemised individually. But when they hand over a mandate to a third-party manager, it often just discloses the manager without disclosing what's in it.
The weighting.
So the certainty of asset allocation and transparency to know that it's what you're actually getting, those two features are incredibly valuable.
Now, there are, I just did confirm, NetWealth have a B2C offering.
Okay.
They call it their Super Accelerator product. So you can just log in and do it yourself. But this speaks to this whole one you want to have, if you're still in accumulation and maybe got debt or dependence, you want to make sure your life insurances are set up independently through a separate advisor. That's a whole other thing. It can still be paid from the super funds, but it's not tied into the...
So you don't necessarily want the insurance tail wagging the investment dog.
Nope.
For some people, though, the super fund is the only place they can buy insurance, either because of what they do for a living, what they do for a hobby, or their health. And that's why the government mandates that all My Super products
have a default.
Must offer default cover.
Yep. So I'm just having a look. The NetWealth fee for their Super Accelerator Plus, from $500K to $1 million, their fee's 0.17. Like, so go with me, Vince, baby. If you're like, yep, I got 500 grand in super, move to NetWealth, throw 500 grand into VAS, 100% Australian shares. Not saying this is good advice or advice at all.
Yes, don't try this at home.
Don't try this at home. In theory, your total superannuation fee would be 0.17 plus what's the VAS?
0.07.
0.04?
07, I think.
It's cheap. Like, you could literally have your full super invested in a wrap account, good flexible tax structure, by yourself, no advisor, for well under 0.4.
Yeah, so that would be, for a big balance, that would be competitive with the House Plus index products.
Yeah. Now, in finishing, there was a question, and the heap of questions, I haven't read out heap, but we've covered most of them anyway, if not all of them. The member direct options, I think Australian Super, Host Plus,
and CBUS are the big
CBUS have these. Are they, if I buy the member direct, log in and buy CBA shares, what happens if I then have 200 grand in member direct in accumulation and want to go member direct pension phase? Can they do a paper entry?
Yes and no.
Okay.
So they're getting there.
Yeah.
And these are, bear in mind that pre-1999, the only way to fix this problem was with a self-managed super fund.
Yes.
Right? 1999, we got wrap accounts. In the meantime, public offer funds were unitising, And now we're starting to see them react to this desire among some consumers to exercise investment control. So the three providers you just named all offer an ability for an individual member to say, I want to buy VAS or I want to buy CBA, and that trustee will go and do that. And if you're going from accumulation to retirement, like a full pension, it will move seamlessly for the bit that's in direct. So it solves much of that tax problem.
But if you wanted a TTR?
But if you want a TTR, it doesn't work. So none of them support TTRs, and that is a transition to retirement pension. And as people are getting older retirement, so the average retirement age now is 64 point something, more and more people are going to want to go through that transition period. So you've got to shut off the access to a TTR in order to get that benefit. It's also, you've got a limited choice. So if I look at the Host Plus one, for example, I can only have 80% of my money in ETF shares and LICs. So I've got to have 20% either in cash or in a premixed option. And there's only 29 of the hundreds of ETFs available on the menu, including some fairly significant.
Do they let you buy the gold ETF?
Yes, they do. I must admit, that was one that, we're big fans of, so we include gold in most of our portfolios at Life Sherpa, but that was one that did surprise me because I'm not aware of any public offer fund in Australia that includes gold in its ordinary diversified portfolio. But yeah, the gold one is in. The PM gold one often isn't, but the Global X one is. But IAA is an odd exclusion. That's the Asian large caps. Well, that's a bit odd. They've only got 3 LICs on the menu.
Yeah.
Like Argo's not on that list.
Wow.
So,
but this comes back to the trustee has a responsibility.
Exactly.
Yeah.
So this is about exercising your ability to instruct the trustee under Section 99.
Yeah.
But the trustee still has a trustee obligation. So they're not going to allow you to punt
100% crypto.
Yeah, or 100% CBA.
And that's the same with these, like the superhero thing. I think 60% of it has to go into the Vanguard.
And so
diversified. Anyway, we've got to bring this home.
The other things they don't do, they don't automatically rebalance. So you've got to manually rebalance.
But a wrap account you would do.
Your advisor's going to do that as part of their
But
portfolio.
you could do it on net wealth.
You could do it on net wealth. You can't. All cash that goes in has to filter through the main fund. So when your employer puts the money in,
you're getting transaction costs. So you can't just. But you could, in theory, just set your main fund to cash option.
You could, yeah. But you've got to keep 2,000 in a premixed fund as a minimum.
Right.
So do you really want to be sitting on it in cash?
Yeah.
So I don't think there's any legal requirement. And so money coming in and going out has to come through the main account, and it has to be proportional across all options. So yes, they're getting there. It's not quite there yet.
Yeah.
So the ultimate flexibility self-managed super fund, which was the only answer pre-99, that's a step too far for most people.
Well, it's just not
I've
needed.
shut mine down.
Yeah.
I just got so over the compliance.
Yeah.
And paperwork, should I say. And the wrap account provides a really good halfway house, gives you most of the advantage of a self-managed super fund without any of the paperwork hassle. And these direct options are slowly getting there.
Yeah. And just on that, like a lot of people, when they want to build their own investing portfolio and all that stuff, like I literally have my equity portion of the fund in one of your Life Sherpa Invest portfolios via my self-managed super fund. Now, I'm in the money world. I do money stuff every day. And maybe I'm just a real-life example of the Dunning-Kruger effect table where what do I know about portfolio management?
Yeah. So what makes you think that you can do better than people whose sole focus is doing this?
Yeah.
Some people can. I mean, for some people, many of whom are in the group,
Yeah.
investing is like a hobby. And, yep, that's a great thing.
Maybe
But for the vast
carve
bulk of people,
10% of your portfolio out, have that as the hobby and put the rest to work,
so
Yeah, but look, hopefully that's given you some insight into wrap accounts. But like anything, you need to understand how the lay of the land works first. Then we can go, okay, this is the differences, and it could be 0.3 to
the tax
3 to 5% ish.
of your ending balance.
Ending balance.
Well, the tax alone is worth about 0.3 a year or 5 to 10% of your ending balance.
Yeah, that's what I was. Yeah, 0.3 or 5 to 10% of your ending balance. Now,
and don't take my word for that. Vanguard comes to a similar conclusion.
Yeah.
So they will publish. You go to the Vanguard website, and they will show you the effect in a super fund environment of this unrealized capital gain.
Yeah.
So you'll need to go to the advisor site.
Yeah.
But they publish this every month for their big funds.
Yeah. So look,
don't take my word for it.
As I said, I don't care what anyone does. I'm just here to educate, give examples, and hopefully dispel some myths. We were talking before we press record. There's a financial advisor in Sydney who recommends ART for most of their clients. And that's fine. The shoe fits for whatever reasons, right?
Yep. And for a $20,000 balance for a 25-year-old,
knock yourself out. Yeah. So not everything is for everyone, and it's just about learning more. If you want to continue this discussion, you can do so in the Facebook group. Otherwise, Be respectful. Don't be dogmatic. But if you found this episode useful, please forward it to a friend or family member. Hit subscribe on YouTube because we're doing more of this stuff on YouTube. And we really love having you listen to our podcast. Vince, Scully, thank you so much for joining us on Retire Right.
Thanks for having me. It's been a wrap. That's a wrap.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.